Welcome to Boxes and Lines, a different kind of finance podcast from a different kind of stock exchange, featuring IEX founder Ronan Ryan and Chief Market Policy Officer John Ramsey. Now here to give you the straight talk on how the markets really work, it's Ronan and JR.
Welcome everybody to the latest episode of Boxes and Lines. Take it, John.
Welcome to Boxes and Lines to Amy Magnotta. Magnotta.
That's his attempt at the introduction to our guest, but
Yes,
I'll do
sorry.
the proper attempt. We're excited to have Amy Magnotta, co-chief investment officer at Ategenos Capital, joining us today.
And we just had to tell him how to pronounce that. He didn't know it. Yeah,
you should see how I've written it on my piece of paper so that I pronounce that correctly. But I think I did do that. Amy brings over 20 years of experience in asset management. Prior to moving to Ategenos in October, she was with Brinker Capital for 16 years as head of discretionary portfolios, overseeing a wide range of multi-asset class portfolios and multi-manager mutual funds. And if that's not impressive enough, she also spent time at BlackRock, where she honed her skills in managing institutional client services. And today, she's here to share her perspective on current market trends and investment strategies. And I'm all out of air.
Yeah. All out of air and out of ideas.
Welcome, Amy. Take it away.
Welcome.
Thank you for having me. Happy to be here.
So you guys just launched earlier this year, so it's quite fresh as a new entrant.
It is. So we launched. We came together kind of late in 2022, and then officially launched here in 2023 as we registered with the SEC as an investment advisor.
And while we made fun of myself, not your name, not the name of your firm, but maybe you could tell us where that name derived from. We got a little education, listeners, right before this.
Sure. So Ategenos is a Gaelic word for rebirth, reborn. One of our COO's wife came up with the name and our logo, which is impressive. For us, we all came, there's 12 of us here. We were all at a previous firm, Brinker Capital. So coming together here at Ategenos, trying to build something to serve financial advisors and bring the experience that we all have in doing that. So we're excited.
That's great.
And just as a little icebreaker, Amy's coming to us live from Philadelphia today. We don't like Philadelphia sports fans. No, I'm only joking.
That's not true. Speak for yourself, Ronan.
I'm a New York Giants fan.
Like them. Yeah, well, he is, but the rest of us are not similarly inclined. So,
but you're very welcome on our podcast.
Mm-hmm.
Yeah.
Well,
are you from
know,
Philadelphia area, Amy?
I am. I grew up in the suburbs here in Philly. I went to school in Pennsylvania, and then I spent a few years in New York City working, but then came back. Couldn't leave Philly too long. And we are very passionate about sports. I think that's...
I got to tell you, your fans are like crazy when they come to like Giant Stadium. Now, I can't talk smack about the teams because your team is way better than us at the moment. But
that's for sure.
Our fans are nicer.
Yeah, it was a tough day here yesterday after the brutal loss. I think it's part of Philly to be defensive about your sports team. So I think being sports fans, we're not all bad. I've been to Giant Stadium. I don't think they were that nice either, but it's been a decent run in Philly, but we haven't won a ton. So still waiting.
Yeah. Well, the COO of our exchange, Stan Feldman's from Philly, and he's passionate.
He is very passionate, as those Philly fans tend to be, and we respect that, even if Ronan doesn't like them. So, Amy, I know that from listening to some other interviews, you sort of given your thoughts on the Fed and interest rates. It feels like assumptions about whether the Fed is done or not overhang people's projections about what's going to happen with equity markets and the broader economy generally. And it sounded as of, mid-month, last month, you weren't sure that they were done, but everybody seems to be assuming that the Fed is probably done raising rates. They just don't want to say it. What are your thoughts about that?
Maybe you could shorten it by half. That's fuck's sake. Amy had to go to her next meeting. It's fucking 2:00.
I think they're done. So we even had Governor Waller come out last week and put cuts on the table for spring 2024. So, and then they try to walk it back. So they keep, depending on who's speaking that day. But I really think, they're done. Inflation has come down, but they can't say they're done because they need inflation expectations to kind of stay lower. So they can't let those go out of control again. And then they might have to walk that back. So I think we could see some maybe targeted rate cuts at next year. If inflation comes down, they're kind of left the door open. So it doesn't even need to be, growth can still be okay as long as inflation's coming down to their target.
Right. Well, and I'll tell you why this matters to me personally, especially is that over 7 years ago, I refinanced my mortgage and I stupidly got an arm, figuring that I would hold on to I would definitely sell the place within the next 7 years. And so, of course, that didn't happen. Now rates, perfect storm. Rates have jacked up. I'm now at nearly 7% interest rate. So I'm thinking, are they ever going to come down now?
And you think we'll solve it on this podcast?
Well, I don't know, but I would
Why
help
did you
if
do
you
an
could.
arm? For God's sake.
Give me like a.
Yeah, exactly. I think that should have been a 2021 lock in a 30-year fix, no matter what.
Yeah.
Now we have guests abusing you. This is
now,
great.
yeah, you're his new favorite guest.
EAGLES. Classic.
All right.
Let me go. I have a question for you because in answering the Ategenos name, you'd mentioned that many of you had come from Brinker Capital. So I guess you've all recently transitioned there. And now in your new role as co-CIO, could you highlight the regions or areas that are currently the focus for generating alpha? And a follow-on question to that is, what makes these areas stand out in your current investment strategy?
Sure. So the way we think about building portfolios and our solutions really are, for clients in $10,000 minimum investment in a model portfolio up to a, multi-million-dollar kind of customized portfolio. We have the same investment philosophy and try to build the same types of portfolios. How we think about it is being very flexible in our portfolio construction process. So we look at core exposures. So we're broadly diversified. So we're going to be in U.S. equities, international equities, fixed income alternatives. And we're going to get some cheap, kind of inexpensive beta exposure in some of those asset classes like U.S. large cap or international developed core fixed income. And then we're going to complement that with multiple alpha drivers. And what those are for us are tilts. So they could be, asset class over underweights, sub asset classes over underweights. We had a value overweight last year. We're kind of neutral right now, but, those types of tilts within asset classes and across asset classes, whether we want to be over or underweight, say U.S. versus international equity. And then a second alpha driver would be thematic exposures. So these can come up from some of our macro research and some of our own internal thoughts about where there's opportunity that we can take advantage of. So a couple of those.
And when you say thematic, can you give a couple of examples?
Yeah. So today, Japan has been a theme in our portfolios, Japanese equities, since we launched the firm and launched our portfolios. That's an area where we think is pretty attractive for a few reasons. Valuations very attractive. Some companies have better shareholder friendly policies now. Monetary policy was relatively easy compared to the rest of the world. So those types of things feed into our view that Japan should be an overweight in a portfolio. And sometimes our themes could be shorter term in nature or intermediate term in nature. Short term for us is kind of six months. So Japan's been a little bit more longer than that, so intermediate term. And we get exposure to that we're just using a broad-based ETF today. So we're using just to get broad-based exposure to the market. And some other areas in natural resources have been a theme, infrastructure in the US, and we can talk about that. But those types of opportunities, we also think we can add value through. And then the third way is just through including some active management. We've been pretty experienced in finding active managers that we think can add value across asset classes. So we're going to put them into the portfolio when that makes sense.
And Japan is an interesting example too, because the rap on Japan for, so many years was that sort of in long-term decline, long period of deflation, even demographic, the adverse demographic trends, et cetera. But that in your view, has turned around, or at least there are other countervailing factors that sort of mean that there's better prospects going forward?
Yes, I think they've, at least gotten somewhat out of that deflationary environment. And they're really committed to growth, and earnings growth in some of the companies has been pretty strong. So we think it's attractive. Also, valuations compared to what we're seeing in the U.S. are pretty attractive there as well. And I think, just to your point, it's been under-owned institutionally. So people have been pretty underweight and down on Japan. So really any move to maybe even a neutral weight or an overweight will be a tailwind.
That was a very intelligent question.
Well, thank
you,
you.
John.
I know.
Right after
Ronan
we
just looked at me with wonder.
I don't know. He was just telling us he has a
stunned
7-year
that I could
arm.
actually put together.
Yeah. Hey guys, I did the dumbest thing on my mortgage, and then he blacked out and asked a really good question.
Well, I thought I had to try to redeem myself. In some way.
You did almost.
Thank you.
You did, Amy. You mentioned infrastructure in the U.S. What's that about?
Yeah, I think so. There's been, some of the policy towards Infrastructure Investment and Jobs Act in 2021, 2022. Some of the Inflation Reduction Act was geared towards infrastructure in the U.S. So I think this is an area where the money, it takes quite a bit of time for that to move in the government. So the money hasn't even been allocated or spent yet. So that could be a tailwind for companies in the U.S. related to infrastructure. Again, we're going to allocate to it through a broad-based ETF. We're not going to pick individual companies because we're more asset allocators and just thinking about the theme broadly. But that could be something we think 2023 has been a good environment for that, and we think that can continue into early 2024.
So 2024, as all of us know and are reminded constantly, is an election year. It's in particular an election year that is likely to
spicy.
Yes, create more than usual level of volatility. Particularly, how do you think about navigating those choppy waters, if you will, sort of going into this election year?
That's a podcast pro question.
Yes,
well done.
Thank you.
I think it certainly will spark volatility. I mean, election years seasonally tend to be back-end loaded, so a little bit more flattish coming into the election and then rally post-election once there's some sort of certainty. But also in past, and I don't think the S&P has declined in an election year when a president is seeking re-election, I think since 1950 something. So, but this year, I don't see a lot of appetite for stimulus. Not necessarily appetite, but the ability to get anything done.
Yeah.
So that could be something that maybe is a little bit where we had in previous election years, and that we don't have this cycle.
Right. So if we do end up with not just a soft landing, but some kind of, sort of soft recession or whatever in circumstances where you might think there would be a stimulus response, that's less likely to happen now just because of the political dysfunction, shall we say.
I agree. I think it would have to be much worse than a soft recession or a mild recession to really get something going.
Yeah.
It's as if you guys met for coffee before.
Well,
this
it's just, two smart people just talking about interesting topics.
So, Amy, we're a stock exchange. So in a lot of cases, we deal with like the actual execution of the trade as opposed to like the asset allocation itself and regulatory changes and this type of stuff. So that's why I'm letting John ask some wonky questions here. Yeah. Okay. Let's go back to more reasonable questions. This one is actually interesting to me. With your extensive experience in active management, how do you see the trends and outlook for active managers versus passive strategies in the coming year?
Yeah, I think it's shaping up to be a pretty good environment for active management. Certainly that QE environment is difficult for active managers to really add value. So I think we'll see a little bit more differentiation. This year's been difficult too, with just how narrow the market's been. And we tend to see when markets are that lopsided, cycles mean reversion, and we'll see some broadening out. But I think it'll be a good environment for active management. We tend to try to focus on more concentrated managers that have high active share that really look different than a benchmark, because we're going to pair them with some broad passive exposure. And we like to focus on active in areas where it makes more sense in, say, small cap, for example, where they're in small cap companies. I think it's 40% of the Russell 2000 around are not earning. So you don't want to be invested in passive there. You want higher quality companies. So we're going to find an active manager there that makes sense. But I mean, we can find good active managers in large cap space. It's just a matter of making sure they have the skill. And again, we like those concentrated managers, give them a better opportunity to really add value.
Cool. Thank you. And we've talked about it a few times that we're coming up on the end of 2023. So curious what you think the lasting impacts of 2023's market performance on investment strategies and decision making.
I think coming into 2023, everyone was calling for a recession, right?
Yeah, that's true.
So, and we knew the Fed was going to have to raise rates to get inflation under control. And we didn't see a recession, and we barely saw a slowdown. I mean, growth's pretty strong still in the third quarter and positive here in the fourth quarter. So I think ignoring some of that noise coming in and making sure that you're in a portfolio that you can stick with and make sense for your time horizon, your objectives, and ignore some of that macro talk. I mean, I think the bearish case always sounds a little smarter. And then the other thing I would say, just how narrow the market was this year, looking at the indexes, it kind of masks what actually went on. So looking at, large cap, mega cap growth compared to small cap value, there's a huge dispersion. So there was some opportunity there. And I think looking forward, there'll be opportunity in some of those areas that were kind of left behind in 2023.
So you think there may be a change, a sort of rebalancing or a change in terms of large cap versus smaller cap stocks?
I think small caps look, just on a valuation basis, pretty attractive relative to large cap. We still like large cap, and even the large cap, mega cap, the Magnificent Seven, they're still growing. And so, but I think there'll be some opportunity potentially outside of that in 2024.
I never heard the term before. The Magnificent Seven. That sounds like a Marvel Comics movie.
Yeah, I was going to go, this is probably a stupid question, but I've never heard of the Magnificent Seven either.
It's like what people are calling now is like Netflix, Google, Microsoft. It's the new FANG.
It's like FANG expansion.
Right. Yeah.
Oh, it's a better name than FANG, actually, to be honest.
Yes.
Yeah. In our space in trading and technology, right, we're getting smacked with, questions about AI, technology changes, data analytics, that type of stuff on the trading side. And I'm curious, how you see the future of asset management heading, particularly with things like AI or technology or data analytics or just changes in that space.
Yeah, it's going to be pretty interesting. I think we're trying to really embrace that technology. I think anything that will help us make better, more well-informed decisions is going to be a positive for our investors. So we're really going to embrace that. When we're trying to allocate assets to active managers, trying to understand how they're incorporating AI into their process and picking individual securities is interesting. Certainly going to boost some productivity in certain sectors and industries. So that's an opportunity. And then I think just our investors are going to be more well informed with all the information that they have. And so we have to just do a good job communicating that and staying on top of, what they want to know with all of that information at their hands, what is most important to them and what should they pay the most attention to.
Cool. Just say AI before anything with your clients.
Yeah, I know. That's like,
That's our industry's.
The term. Well, I think I'm going to turn my personal finances over to an AI bot at this point. I think, hopefully be better at making.
I won't even bring up the arm again.
I was going to say, I wonder what it would say about
the AI robot would fire him.
You idiot.
Your money is not good enough. Clearly, this will not work. You have any other questions, John? I have more. Yeah.
You've been in this business a while. You have in a lot of different iterations. You obviously, as a woman, you have been very successful and have seen lots of different environments. Are there any kind of personal perspectives that you would share about the course of your career or pivotal moments or things that really made a difference or led you to where you are today?
Yeah, I think, I graduated college in 2000. So entering this industry right before the tech bubble was interesting times, more in an institutional environment. I spent some time in private equity as well in an institutional environment. And I think the needs of those institutional investors are much different. It's not the what I'm working with now, which is more of an individual investor or financial advisor, those needs are a lot different. So for me, I moved to Brinker Capital in late 2006. So just before the financial crisis. So learning what institutional investors need in those times of market stress versus what more individual investors need was a wake-up call. Need a lot more communication and hand-holding and venting, listening. And I think those were just two good environments for me to learn about the industry and just what investors need. And then you mentioned being a female. I think starting in 2000, we're now, we're still underrepresented, I would say, but even more so back in 2000. So finding that good kind of female mentor for me, which I did at BlackRock, it was so helpful in getting through, and learning from, have so many bad meetings in some of those environments, and just really getting through and how to persevere on the other side and learn from that. I think was very important, and something. I have two daughters. One's getting ready to go to college. So, those are things, just, find that person that you can really learn from. And hopefully people will return back to the office and there'll be a better environment for that to happen.
Oh, well, amen. That also is something we talk about often and also an interesting question is your views about the value of in-person collaboration and office attendance in the business that you're in, because there are people who sort of act like this can all be done remotely. There's no reason for people, and I really question that.
I agree with you. I think especially during times of market stress where you want to kind of talk through different, theses or just things that are going on. How does that impact what we're working on in portfolios? How does it impact our clients? Those are things that it's just not the same, remotely. So, and I think for just bringing young people on, it's so important to be in person. And there should be certain times where there's certain times where I want to be at home and I want to read and think and write, and that's fine at home. But I think also, part of what we do in hiring active managers is doing interviews on site. It used to be a big part of what we do, and we're kind of going back to that. It's so important to sit across the table and learn from, understand the team, how the team operates, and then you can meet with more people and really get a good sense of that strategy and how it works and what drives performance. And it's important, and something I think we lost a little bit doing it over Zoom.
Absolutely. The one thing that is good about Zoom is I've discovered there are filters that you can use that will make me appear slimmer. So I've relied on those, but yes.
And younger. You can use those too.
Yeah, well, absolutely.
Or you can blur out the crazy shit in the background. Yeah.
Yes.
So we have one more question for you. We used to ask every guest what their favorite Wall Street movie is and why, and then we got more fancy as of late. So your question is, John.
Yes, if you could give a one-sentence piece of financial advice, Amy, to your younger self, what would it be?
I think it would be let your time horizon work for you. I think that's just the most important thing when you're younger, is to build that wealth and start accumulating that wealth and take advantage of things like 401k matches when you don't really understand, why you're doing that. And I think it's so important to be able to start that early. So,
and don't refinance with an arm.
And don't,
right?
Exactly.
Yes.
No, Amy, you're so right, because I'm no financial wizard, but I was talking to one of the young guys on the desk, because my daughter's a sophomore in college and my son's going into freshman year. And we did the 529s when they were like infants. And it's almost like college is free. We had to put the money away.
That's right.
But now I'm writing checks out of that account without having to actually go into money that I consider mine.
Exactly. I think it's like a Venmo balance where you're just like, oh, that's free money.
Exactly. It feels free. It's amazing. So I'm very proud of myself. Thank you, John. And I've never had an arm.
And hopefully when you tell your kids that, they'll think that that's a smart idea and they'll do it themselves. But
yeah, probably not. But,
they don't listen to me. Maybe they should listen to their mom. Well, you've been a fantastic guest. We appreciate you joining us.
We have, and don't we have a gift?
And we do have a gift, and I want to apologize for any negative comments I made on the Philadelphia fans. You're all right by us, Amy.
Absolutely.
All right, I appreciate it.
And
Thank
everyone
you so
who
much.
joins gets a pair of IEX boxes and lines
Socks! We give you a pair of wonderful warm socks.
I
for the
will.
winter.
I will say though, everybody does say the socks we give out are good. Normally, when you get like tchotchke like socks, they're like acrylic and crap. Ours are the real
Yep.
deal. So you'll be very happy in the IEX socks.
Awesome.
You've been delightful and smart and funny, and we've enjoyed having you on. And I apologize. I would apologize for Ronan, but I can't do anything about it. So.
Over and out. Boxes and lines.
Oh, good. Thanks so much.
Are you a diehard boxer or liner, or just a fair weather fan? No judgments, I know how annoying JR's Irish accent can be. Either way, we want to hear from you on our new Boxes and Lines listener survey to find out what you think about the show, give input on future episodes, guests, and more. We'll take it back to our survey counter thingy machine and consider all of your inputs as we plan our 2024 season. You can find the survey at iex.getfeedback.com/boxesandlines. And don't worry, there's something in it for you. That's my drum roll. JR could probably do it better. You get a pair of socks. That's right, take the survey, we'll send you a pair of our coveted Box and Line socks while supplies last in a new limited edition print. How's that for listener appreciation? So take the survey, tell us what you think, and thanks for listening. Again, that's iex.getfeedback.com/boxesandlines. Over and out.
Boxes and Lines is a podcast from IEX Exchange. It is hosted by Ronan Ryan and John Ramsey. Executive produced by Daisy Clace, with support from Benstown. For more information and to hear more episodes, go to iexexchange.io/podcast. Thank you for listening to Boxes and Lines. The information and opinions expressed in this podcast are provided for informational and educational purposes only, and IEX Group Incorporated and its affiliates do not make any representations or warranties as to the accuracy or completeness of the information contained in this podcast. Nothing in this podcast constitutes a solicitation or offer to buy or sell any securities or provide any investment advice or service. Some portions of the preceding conversation may have been edited for length or clarity. Copyright IEX Group Incorporated, all rights reserved.